The stock market can be a complex and fascinating world. It's a place where fortunes are made and lost every day. But what happens when the game is rigged? Insider trading is like playing cards with someone who can see everyone's hand. It undermines the very foundation of a fair and transparent market. This illegal practice not only harms ordinary investors, but also erodes trust in the entire financial system. In the following sections, we'll delve into real-world examples, analyze data, and discuss how you can protect yourself from this insidious practice. To understand insider trading, let's look at Nifty 50, the index of top companies on the National Stock Exchange of India. We'll focus on Reliance Industries to illustrate how unusual activities can hint at insider trading. A sudden surge in trading volume just before a major announcement is notable. This, coupled with sharp price movement, could indicate insider trading. While not conclusive, it raises red flags for further investigation. Recognizing these red flags can help investors avoid pitfalls. Technical indicators like the MACD, Moving Average Convergence Divergence, and RSI, Relative Strength Index, can provide valuable insights into stock price movements. While these indicators are not foolproof detectors of insider trading, they can highlight unusual patterns that might warrant further investigation. The MACD, for example, can signal potential overbought or oversold conditions, which might coincide with insider activity. A sudden and sharp divergence between the MACD and the stock price could indicate that insiders are either buying ahead of positive news or selling before negative news becomes public. Similarly, the RSI, which measures the magnitude of recent price changes to evaluate overbought or oversold conditions, can also provide clues. An RSI reading above 70 is often considered overbought, while a reading below 30 is considered oversold. Extreme readings coupled with unusual volume spikes could suggest insider trading. It's important to note that technical indicators should not be used in isolation. They are most effective when combined with other forms of analysis, such as fundamental analysis and market sentiment analysis. Fundamental analysis delves into a company's financial health and growth prospects. Insider trading can be spotted by analyzing revenue growth, EPS, and PE ratio with unusual stock activity. A sudden stock price surge without improved fundamentals could be a red flag. This might indicate insiders inflating the stock price based on non-public information. Conversely, strong fundamentals with a sudden stock drop could suggest insiders know negative news. Let's shift our focus to Infosys, another heavyweight in the Nifty 50. This case study will further illustrate how insider trading can manifest in different ways and the challenges in detecting it. In contrast to Reliance Industries' example, Infosys chart shows a period of relatively low trading volume followed by a sudden surge just before the company announced better than expected earnings. This pattern suggests that insiders might have been accumulating shares at lower prices before the positive news became public, leading to a price surge when the information was finally released. This example highlights the difficulty in pinpointing insider trading. Unusual activity is not always about sudden spikes or drops. It can also be about subtle shifts in trading patterns that only become apparent upon closer examination. Analyzing multiple indicators, including fundamental factors, technical indicators, and market sentiment, is crucial to building a comprehensive picture. Insider trading is not just unethical, it's illegal. It undermines the very fabric of a fair and transparent market. When individuals exploit their privileged access to information for personal gain, it creates an uneven playing field that harms ordinary investors and erodes trust in the financial system. The legal ramifications of insider trading are severe. In India, the Securities and Exchange Board of India, or SEBI, is the regulatory body responsible for investigating and prosecuting cases of insider trading. Those found guilty of this offense can face hefty fines, imprisonment, and a ban from participating in the securities market. Beyond the legal consequences, insider trading carries significant ethical implications. It violates the principles of fairness, transparency, and integrity that are essential for a well-functioning market. When individuals with insider information profit at the expense of others, it creates a climate of distrust and undermines the integrity of the entire financial system. Combating insider trading requires a multi-pronged approach that includes robust regulations, stringent enforcement, and a culture of ethical conduct among market participants. Section 7. SEBI's Vigil, safeguarding market integrity against insider threats. SEBI plays a crucial role in safeguarding the Indian stock market by investigating and prosecuting insider trading. The regulatory body has stringent regulations and surveillance mechanisms to detect and deter this illegal practice. SEBI's insider trading regulations define insider information, prohibit insider trading, and outline penalties. SEBI employs sophisticated surveillance systems to monitor trading activity and identify suspicious patterns. SEBI also conducts investor education programs to raise awareness about insider trading and its impact. Section 8. Empowering investors, recognizing red flags and making informed decisions. While regulatory bodies like SEBI play a vital role in curbing insider trading, investors also need to be vigilant and take steps to protect themselves from this illegal practice. By understanding the red flags and adopting a cautious approach, investors can make more informed decisions and minimize their risk. One crucial step is to be aware of unusual trading activity, such as sudden spikes or drops in trading volume or price movements that cannot be explained by publicly available information. Investors should also be wary of rumors and tips, especially those originating from unreliable sources. Conducting thorough research before investing is essential. Investors should analyze a company's financials, understand its business model, and evaluate its management team. This due diligence can help identify potential risks and avoid investments in companies with questionable practices. Diversifying investments across different asset classes and sectors can also mitigate the impact of insider trading. By spreading their investments, investors can reduce their exposure to any single stock or sector that might be affected by this illegal practice. Section 9. The Call to Action, fostering a culture of transparency and ethical trading. Combating insider trading requires a collective effort from regulators, market participants, and investors alike. Fostering a culture of transparency, ethical conduct, and accountability is crucial to maintaining a fair and efficient market that benefits all participants. Regulatory bodies like SEBI play a critical role in setting clear rules, enforcing regulations rigorously, and imposing deterrent penalties on those who violate the law. They also need to adapt to the evolving tactics used by insider traders and leverage technology to enhance surveillance and detection capabilities. Market participants, including listed companies, brokers, and analysts, must prioritize ethical conduct and implement robust internal controls to prevent insider trading. This includes establishing clear policies on insider information, restricting access to sensitive data, and monitoring employee trading activities. Investors should demand transparency from the companies they invest in and hold them accountable for maintaining ethical practices. By supporting companies with strong corporate governance and a commitment to transparency, investors can encourage a culture of integrity in the market. Section 10. Conclusion: protecting your investments in an age of insider information. In today's interconnected and information-driven world, the threat of insider trading looms large. Those with privileged access to information can exploit this advantage for personal gain, harming unsuspecting investors and undermining the integrity of the market. By understanding the concept of insider trading, recognizing its red flags, and adopting a cautious approach, investors can make more informed decisions and protect themselves from this illegal practice. Remember to conduct thorough research, rely on credible sources of information, and be wary of unusual trading activity. Promoting a culture of transparency, ethical conduct and accountability is paramount to combating insider trading. Regulatory bodies, market participants, and investors must work together to create a level playing field where all participants have an equal opportunity to succeed based on publicly available information. Remember, knowledge is your best defense. By staying informed, being vigilant, and demanding transparency, we can collectively create a fairer and more ethical market for everyone.